Cloud. Hey, so welcome everyone to this Kingdom REI webinar. And I believe today we're talking about how to start and structure your real estate fund. So really looking forward to getting into that and just kind of walking you through that. I'll talk about that here in a minute. But really quickly, my name is Ellis. If we have not connected or met, I'm the founder of a mastermind community called Kingdom REI. I know there's a couple guys in here who are actually a part of that mastermind or planning to be part of that mastermind in the new year. Really, it's our heart, our desire to build a community of kingdom-minded, faith-driven real estate operators and investors who really have a vision to grow and build their real estate business for the glory of God, the good of others. We really see capital as a means to have tremendous influence for the kingdom and want to build a community really around that idea of joining together and really helping and serving one another towards that mission and that vision. And today we have about 40 members managing a little over $2 billion of assets. And our prayer, our vision is to really build a community of over 200 people who are managing over 100 billion. So we're on our way. We're on our way, and we'll be there in no time with God's help. So if you're interested in being part of this community, contact me, reach out to me directly, or go to oneconnectionaway.com. And you can learn more about our community there. So I definitely make sure you check that out. If you're just joining us, welcome everyone. I'm glad that you're here. I was just telling a little bit about our mastermind community, Kingdom REI. We also have a podcast show called Kingdom REI. So today, like I said, we are going to be talking about how to structure your real estate fund. And before I say too much, or before I start teaching, I feel I'm not a lawyer, I'm not an attorney, but I always hear attorneys say this, right? Like, I'm actually not telling you what to do here. I'm just, and seriously, in this way, I think there's probably a lot of things my attorney would be like, oh, don't teach him this or don't tell him this. So here's what I'm going to do today. I'm just going to tell you exactly what I'm doing and what I did to start my real estate fund in the way that we're doing it. And then we'll open it up for questions, or you can ask questions along the way. But I think the way that we structured our fund is has been well received. I think if you're interested about investing in real estate or starting a real estate fund or even investing into a real estate fund, hopefully today will be really helpful as I just kind of walk you through what I've been up to over the last several months in starting our real estate fund and how we're kind of bringing that to the marketplace today. And so I'm going to stop sharing this so that I can share with you our fund structure here. And please, if you have questions as we go, put them in the chat and I'll make sure that we get to them. I'll make sure that we get to them today. So I can see you, David. Give me a thumbs up if you can see my screen, this fund to funds model here. Awesome. Okay. So we just launched what we're calling the Mission of Multifamily Fund 1. This is part of my story too, of being a missionary and now, being a full-time multifamily investor, and really having this mission and vision of using real estate to create kingdom impact. And so that's kind of the idea behind the name of the fund, Mission of Multifamily Fund 1, Strong Return Spiritual Impact. I kind of go through this a little bit. I think from a fund perspective, if you're going to start, the difference, and let's be clear here, the difference between a fund and a typical syndication that maybe several of you are familiar with, or a single asset fund, for example. What we're talking about today and what I've structured is I've actually structured a fund that will be investing into multiple assets. Versus the traditional model, or model that maybe you've seen previously, is a single asset syndication or a single asset raise where there's one property, investors are investing into direct shares of that single asset, where this fund is a little bit different in that it's going to be diversified across multiple assets. And distinctively about this fund, and maybe you're thinking about doing the same thing, this is actually a feeder fund. And so what I mean by that is the benefit of this fund and doing a fund is that I'm actually, even though we have our own syndication firm, this fund in particular, I will not be operating these assets. So the relationship that I've created with this group called Waymaker. Hold on 1 second here. Let me make sure. Turn off some of these notifications. Got it. So the benefit for me in this fund, and I'll tell you really quick how we got to this. As you all know, 2020 has been a pretty competitive. I mean, a lot's happened this year, and especially in the world of multifamily. About midway through the year, there was really no deal flow because of COVID. Sellers and buyers were just kind of at a standstill. And then kind of once we saw that multifamily was still performing very strong, if you're in the market, then you know how competitive it actually is now, and how difficult it is if you're not already in the market and have great relationships, how difficult it is just to get deals. And that's been our case as well. And so the fund was an alternative way for me to help our investors get money invested at the end of the year. And so we're doing a feeder fund, which will essentially be placing capital into another operator's bigger fund called Waymaker. And so as you can see here, the reason we did a fund for our investors was it's going to provide an easy way for them to diversify their portfolio across multiple assets. They get to be a part of a much bigger fund called Waymaker, and I'll show you who those guys are here in a minute. But essentially, when I think about a fund, you got to figure out why are you doing a fund? Because here are the drawbacks to a fund versus a typical or traditional syndication model, where you are buying a particular asset and essentially selling shares to that particular asset. It has a lot to do with track record, right? So in some ways, you're selling the team because you're not selling the asset. Now, when you have a fund, you're saying, when you're going to investors, hey, here are the type of deals we're doing. Here's the return expectation. Here's what you get in exchange for your investment. But in a lot of ways, you're raising money before you have assets. And so I do think that's a drawback for some, or it could be a drawback for you, or at least a hurdle you have to overcome. It's a hurdle we're having to overcome right now as well, because most of our investors are more familiar with seeing the actual asset and then giving money, where the fund is, no, they're investing in this fund. The fund then goes and purchases the real estate. So it's a hurdle that you may also have to come over. So the more deals you have, the longer your track record is. I think I think a fund begins to make more sense. But the reason we started this fund is because the investing with Waymaker, they have $1 million minimum investment for you to invest into their fund. And so what we've done for our investors said, hey, we have an awesome opportunity that you can invest into an institutional quality type fund where they're going to be purchasing 250 units or more of multifamily apartment complexes. We're investing alongside a world-class investment committee. And here's the thing. Typically, you would have to bring in $1 million to have access to this fund. But through our real estate fund that we're creating, you can be a part of this for $50,000. And so what we're doing essentially is pooling smaller investors together in order to reach that $1 million minimum. And so that's why we created a fund, and that's kind of our pitch in, as we're kind of separating ourselves from the market and saying, hey, we have an opportunity that you will to invest in deals that as a smaller or ordinary investor, you would never get access to. And this is what we're doing through our fund. I would say a couple of things here, and I'm going to show you our fee structure, because here's the tough thing about a fund, especially a feeder fund, in the sense that like there's the operators, there's our fund, and then there's the investor, right? So we almost are kind of like a middleman to the larger operator. And so maybe that's what you're thinking about doing as well. You want to just be, you're essentially just the middleman. That sounds like a bad name, but I guess what I'm saying is you're compiling or composing. If operators, you have good deal flow, it's a service to your investors, because honestly, most people don't have the time and do not have the relationships. They're not showing up at 2:00 in the afternoon on webinars like this to meet other operators, right? Or they're not a part of a mastermind or whatever it is. So they don't know the deals. I always say, the world of syndication, the world of multifamily is like taking the red pill in the Matrix. It's like whenever I learned about multifamily syndication and I met all these operators and begin to see all the deal flow that's out there and the investment opportunities that are out there, it was kind of like joining being part of the Matrix and realizing, oh my gosh, there's a whole nother world of alternative investing. listen, 95, maybe more percent of the people that I talk to, I mean, 9 out of 10 people I talk to do not know what a multifamily syndication is. They do not invest outside of their financial advisor. Why? Because they don't know. No one's ever taught them, right? And so having a real estate fund is a great benefit to that. The problem sometimes is the fees. And so the way that we've structured our fund, the reason why we were able to do a feeder fund is that we were able to negotiate with the operator a discount so that we could also charge a fee. And so essentially what Waymaker has, which is the larger fund that our fund is investing into, Waymaker has a 1.5% management fee. Okay, so they're charging 1.5% on the money that they have in their fund. Because we were early to the fund, we negotiated with them a 50% discount. So they're charging only 75 basis points or a 0.75%. That allows our fund to charge the other 0.75%. Okay, not a lot of money, but it does at least cover kind of our CPA, our bookkeeping cost. The other huge discount that we got from Waymaker was just like in any typical syndication, once you kind of hit the preferred return, there's typically a split, right, on the upside between the operators and the investors. And so typically in a syndication, typical syndication, it's a 70-30 split. Well, Waymaker was going to have an 80-20 split. They've given us a 50% discount on that promote. And so that allows our fund to take the other 10, or actually it's an 80-20 split in our fund, to make it a net 70-30 split for our investors. And so it's almost net even for our investors to come into our fund and invest into Waymaker, but only have to come in with $50,000. So I think as you're thinking about if you want to have a model like a real estate fund, you have to think about the fees, right? Because especially if you're doing a feeder fund like us, let's say, for example, we have a deal and you wanted to raise money from your investors and do a fund, an LP fund, we're going to have our fees, but you got to figure out a way to get yours paid as well. And so, you might be able to negotiate with the operator, say, hey, if I could bring in 50% of your capital, would you discount your fees, or would you discount your promote to my fund since I'm bringing in such a large chunk of the capital? And I think that's a great way to be able to make this work. And that's essentially what we've had done. So as you can see here are our fees for our fund. We charge a 80-20 split. We're going to give 100% return of capital first. So essentially Waymaker pays Mission and Multifamily Fund 1 just like they would any normal investor, because our fund is on the limited partner side of the deal. So typically on these funds or these real estate transactions, you have a general partnership, which is the management team, right? They have the management equity, and then you have the investors, right, who are the limited partners. You have the limited liability and the limited partnership equity, which is typically the lion's share of the deal. Our fund is on the LP side. We're not in the management. We're on the LP side. So Waymaker will pay our fund just like any normal investor. And our fund will pay our investors over here 100% of their money back until we take anything off the top. And essentially that's an 80-20 split after that. So that's how we've structured it to make sense for our investors. But then also for us as we put this fund together, we have the relationship, we're giving them access to an incredible investment opportunity. That's how we get paid as well. So most of it does come on the backside, but the way that we're kind of getting paid and covering our expenses up front is we're charging our 75 basis point management fee, and we're charging a 2% capital placement fee one time. So essentially, if you invest $100K into our fund, it's like investing $98K because we're taking 2% off the top in order to do that. And it's similar to like an acquisition fee you would typically pay in a traditional syndication, right? You may pay 2 to 3% in an acquisition fee if you were to invest direct with a sponsor. So the 2% placement fee is very similar to that, and maybe even better because typically their acquisition fees are based on the purchase price of the property. And our capital placement fee is actually only on money raised. So it has nothing to do with purchase price of the property. It only has to do with money raised. So in some ways, it actually could be better than your typical acquisition fee that you would be paying to a traditional sponsor. So again, I'm happy to answer more questions on that, and we can come back to this, but I just kind of want to give you the idea of how we set this up, why we set this up. And I think you should be thinking too, if you want to do something like this, what is the benefit of your real estate fund? Because I'll tell you the response that I've gotten back many times already with our fund is, Ellis, why would I invest in your fund? I don't know the assets, when I could just go invest in this other syndication deal where I know the asset. I know what I'm investing in. And so my question for you is, what's going to be your response to that? Right? So mine has been, well, listen, you are not going to get access to these type of deals anywhere with any other sponsor. Why? Because they do not have the team that Waymaker has. And I'll show you what I mean by that. This is the team that Waymaker's put together. Now, if those names don't mean anything to you, here's what they control: $1 million, 1 million units, $100 billion portfolio, 280 years of multifamily experience, and 2,000 multifamily transactions. Typically, the folks, my investment community, they've never invested with a community with this type of experience, with this type of access to the market. And so that's kind of the carve out that we've created, our advantage, right? And so I'm kind of helping you think to say, if you're going to do a real estate fund like this, how are you standing out? What are you doing? Because I think for many of you, if you're not a real estate operator and you just maybe have a network of investors, or you have access to maybe, your family, or many of you work with other high income earners or high net worth folks, there's definitely a way where you could also have your own real estate fund. And like I said, you don't need to be the operator. You're just focused on raising money. And there's definitely a way you can do that through a real estate fund. And so, like I said, this is the way that we've done it, where we're doing a feeder fund, or our fund is just investing on the LP side. There is the other way though, and there are guys in our mastermind who are doing this, where they're raising a fund, and essentially they're also on the general partnership side of the deal. They're investing into single assets. And so they're taking a carve out of the general partnership or the management equity of the project for simply just bringing in a majority of the capital. And so you could do that as well. The safer way is to do like we've done if you're going to do a fund and just invest on the LP, because just to be clear here, I know my attorney would say this, unless you have your broker dealer's license, you cannot sell securities, which is essentially what you would be doing if you're just selling shares of real estate, right? That would be, you'd be selling securities, and you would be, that's illegal by the SEC. What we're doing is not illegal. It's a carve out. It's a way to do this legally by essentially having an LP fund, and we're investing directly into the LP. Same thing if you're on the general partnership of a deal and you actually have management responsibility, then you are part of the project. It's your own project. You're selling shares of your own project, and that's legal when you do a 506B or 506C offering according to the SEC. Again, I'm not an attorney, just giving you my experience here and what we're doing. So there's a couple of things here I want to show you about our fund. If you're curious about what this fund is actually going to perform at, let me get here to this. A couple slides here. Feel free to put in your questions. Would love to answer any questions. I'm trying to kind of show you some different things here. So here's what our fund is really targeting is type of returns. We have the ability to fall somewhere in between 17 and 33% annual returns after some type of liquidation event. On a very conservative level, Waymaker will pay our fund a 6% kind of ongoing cash flow. So we'll pay that to our investors on a quarterly basis. Again, 100% return goes to our investors until they receive all of their money. And then we share in the upside, which will probably be in 5 or 6 years. Waymaker's target is to hit at least 14%, but as you can see from the previous slide, and I don't have time. If you want to go learn more about this, you can go to my YouTube channel, or you can email me for the video walkthrough. But there's much bigger upside to be realized if they can execute on their value add. So there's a tremendous opportunity here to bring something to our investors where they can just crush the market, right? In the sense of they can crush the returns they would get from the market, while we also, as the fund manager, can be compensated very well as well. So we're pretty excited about this opportunity. So just be clear, we're paying out quarterly kind of dividends based on the cash flow that we get from Waymaker, up to 100% of the capital our investors have committed. And then we split the upside 80-20, meaning our investors get 80% of the upside and the fund receives 20%. And so that's the way that we structure. So I know there's a couple questions. Let me pull those up real quick. Chat here. Starting, no worries. Andrew, David, is Waymaker the only investment the fund invests in? For this one, yes. That's because, like, again, they have that $1 million minimum. So we only have, our fund is only a $5 million. So it's capped at a $5 million mark. And so we will not raise more than that amount. And again, I have my own syndication firm. So we're going to be doing our own deals in 2021. So my goal is not to like just create this fund and invest in a bunch of other people. I want to do my own projects. I want to operate our own deals. But this is kind of a way in 2020, in the midst of COVID, to provide a very good offering, I think, to my investment community. You know, even though we're not doing deals, because I'm essentially kind of, you know, I'm gaining and giving access to a group that I think will be much more competitive than we have been able to be, simply because of who their team is. And so, yes, our fund will only invest directly into Waymaker.
You mentioned the difficulty of selling your team and not the investment. But if this is the only investment, then you're able to sell the investment. It's Waymaker.
Yeah, exactly. I mean, that is our pitch. Hey, you're getting access to Waymaker, which, again, only people with $1 million, and it's not even people. I mean, Waymaker is targeting, you know, large Christian mutual funds, right? Who can invest $10 million or more. That's who our $50,000 investor is investing alongside of. So that's exactly what we're doing. We're selling Waymaker, not the deal. What's cool though, and which is the agreement that we have with Waymaker, is that our discount that I was telling you guys about, the 50% discount, will extend through the acquisition of the first property. So I think that's going to really benefit us, because all the folks who said, hey, I want to see the deal first, we actually have kind of that 60-day window of when we go under contract on that first property to say, hey, here's the deal, right? Or here's what a deal is going to look like. See, you know, I told you how great these opportunities are going to be. And so whatever we have not raised, you know, before we put that first deal under contract, I think we'll be able to cover the rest of it simply from being able to show the type of properties that Waymaker plans to acquire and put in this fund. I think it'll be pretty exceptional. So anyways, that's how we've structured it. I would say this, and I'll make this invitation to everyone who's joining this. I mean, I know most of you, like I said, we're raising a $5 million fund. Super important. I should tell you this. This is the last thing, and then I'll open it up for any more questions. So I have another partner on this fund his name's Abel. The way we've structured our fund, I think is pretty unique, because again, we launched a $5 million fund. In all honesty, I knew, based on my investment network, because we have a 506c fund, right? So it's a 506c offering, which essentially just means that we can solicit or we can advertise our fund publicly, and we can only take accredited investors. So those who make over $200,000 a year for the past 2 years and plan to do that in year 3, or have $1 million of net worth, not including their primary residence, right? So our fund is a 506c fund. And so we set it at $5 million. I knew, based on my investment community, I did not have $5 million worth of commitments because one, I only have a community of about 200 folks. I say only, I mean, I think that's pretty awesome, but not all of them are accredited. So what I did was I created kind of a two-tier structure. And I'll walk you through that because it could be an invitation for anyone today listening if you want to have a conversation about this. So we have the fund, Mission Multifamily Fund 1, and then we have our management LLC. And so essentially, Abel and I both have shares of the management LLC. And we've carved out enough equity, essentially the way there's equity in the fund, that we can bring in other capital partners who can bring in investors and give them a piece or a share of our management LLC, right? So that 20% I was telling you about, the upside, Abel and I will share of that 20%, and anybody else we bring into our management LLC who can essentially bring in other investors. Now, there are more roles than just raising money, but I mean, that is the major role there, right? Is you have a network of capital that you're bringing to the table. And so we're able, because we've done this kind of two-tier structure, the way that the equity or the ownership that Abel and I are splitting and anybody else that we bring onto the team essentially is a member of the management LLC, not the fund. The fund just invests into Waymaker, right? Then the fund pays our investors and the fund pays the management LLC. So that's kind of our two-tier approach. And again, that allows us to bring in other management partners who can really help us hit our goal and make this a very successful raise and fun and even experience for our investors. I mean, Abel brings so much to the table in that he has great contacts with other CPAs in this industry. And we're creating a great flow and system to how we're going to report to our investors. And so, yes, Abel is raising capital, but Abel and I talk, 3 or 4 times a week about what we're doing to make this a great experience. So in some ways, like I'm open to partnerships because Abel makes me better, right? Abel is bringing contacts and networking opportunities into my life that I didn't have before. And he's also very detail oriented, which I really enjoy. So anyways, that was a solid 30 minutes. I hope that was helpful. I'm sure it was, because when we started this, I had no idea what to do. I had no idea how to set up my fund and how to get paid, like how to actually cover my expenses early on while creating a great experience for my investors so that we could both share in the upside. I think the way that we've structured this, as you see here, this is the returns, by the way, for our fund. 2.3x multiple is kind of what Waymaker's projecting. Again, this is on the conservative level, 6% cash flow, but the opportunity to receive, on a conservative basis, 10 to 17% or 18 to 33%. But this is what I want to show you. Again, this is what we've created. And this is, I think, the main thing to kind of share with you today. So lastly, if you have a network of capital or you're looking to do something like this, you want to partner on something like this, or even deals that we're doing in 2021. Our team is focused primarily in the Arizona market. We're looking at kind of mid-sized multifamily apartment complexes, anything from 32 to 150 units, and Phoenix, Tucson, kind of Albuquerque, New Mexico is another target market of ours. Would love to talk about joining up, finding ways to joint venture and take down some bigger deals together. That's why I love this business. Why I got into it is the opportunity to work together with folks. One of my mentors always says that there's more juice in a slice of watermelon than there is in an entire grape. And so would you rather have a slice of a watermelon or would you rather have a grape? And that's why I love syndication, because it's the opportunity to really slice things up, because the real estate's bigger. My first transaction was a duplex. Wasn't no room on a duplex. I mean, there wasn't even enough margin in our duplex to hire landscapers. That's why I was doing all the yard work. But in a large syndication project like this, there's plenty of opportunity to share. And that's and not just on the operating side, but with our investors. That's why I love this vehicle. It's an incredible wealth building vehicle that we have found to truly be a win-win for everyone who's involved. And the way that we run our business and the way that, you know, our vision, the way we run our communities is a win-win for our tenants, our residents, because of, you know, the community that we're creating there. I mean, the beautiful thing about our Fun with Waymaker is the spiritual impact. I mean, that's why we did it. It had nothing to do with the returns, even though the returns are incredible. Waymaker plans to impact, you know, tens of thousands of lives spiritually, I mean, transformatively over the next decade, through a nonprofit called Apartment Life, which places Christian families into these communities to lead, to steward, to shepherd, to provide programs and events, etc. So, you know, I love this vehicle so much, because of what it allows us to do, not just from a wealth building perspective, but also from a kingdom perspective as well. So, let me see if there's any other questions here. What is the maximum equity in the capital stack for new ground up projects? We're developers of adult lifestyle. Hey, Ian, what is the maximum equity percentage in the capital stack for new ground up projects, ... I'm not sure I quite understand that question, Ian. If you want to turn on your mic, I'd be happy to speak to that question, for that.
Hi, Alice. Can you hear me?
Yes, I can.
Okay, yeah, we're going to be introducing a new non-profit type of boomers housing, and generally a building would be like 20 million. We'll bring to the table the construction loan of about 70% of that, so 14 million. We put in the other 6 million, but we're leaving room for 500,000 of third-party, you know, equity investor or participant, if you like. So, you know, now obviously if we get involved with a fund that would provide 1 million of that, then, you know, we would be putting in that much less. But between the construction loan and the equity package that we're putting into the mix, all we need, you know, is about 500,000. So does that fall into your wheelhouse, that type of investment in ground up projects?
Yeah, I see what you're saying. If you're asking me personally, the answer is no. Like I said, we don't typically do a fund model where we're just raising money to invest with other operators. We typically are just raising capital for our own projects, which are multifamily syndications in the Arizona market, and New Mexico market. This was a little bit different, right? Because of just 2020 and the opportunity to partner with Waymaker based on our relationship. So to answer your question, me personally, no, because this is not really our model. It's not really the model that we want to have where we just raise money for others. It was more of just kind of a unique opportunity to be able to do that. We thought our investors would really like to do that. However, Ian, since you're here, I'd share some really great resources for you. There's another community that has a lot of different equity groups that, especially since you are faith-based, you know, you're a Christian man, and seems like what you're doing has a real value, you know, a mission-oriented impact to it. faithdriveninvestor.org. There's a ton of resources there. And I just think there's a lot of, you know, I would kind of browse their site. They have several different folks and organizations on that website, faithdriveninvestor.org, that specifically want and look to fund, you know, mission-oriented, faith-oriented projects like that. You know, the other thing, Ian, is that you know, there's groups that you can essentially just pay a fee to bring that money in, you know, and typically that fee can be anywhere from 4 to 6% just to raise that equity for you from like a crowdfunding type source. And you could Google many of those. I was just looking at one the other day, and I believe the fee was 6% for them to essentially kind of host your project on their site, you know, and for them to kind of raise that capital. And again, there are broker dealers out there who would do that as well. So that might be a way for you to kind of.
Yeah, we're familiar with most of them. I want to try and stay with the faith driven, so I'll follow up your, you know, your item there on the faithdriveninvestor.org. When we build these, I mean, this is where the real pay it forward thing comes in. When we build them and stabilize them, we're turning them over to local charities, churches, etc., 100%. we don't want these buildings. We don't need them at this point. So that's the whole pay it forward type of situation.
Yeah.
It works.
Yeah.
So, okay. I'll try that, and I might speak to Waymaker just to see what they're all about, if that's okay with you.
I have no, you didn't have to sign. You can absolutely reach out to Waymaker and their team. These are the guys. I'll show them to you right now, man. They're a great group of individuals. Where is it? Here are the principals of the fund of Waymaker. These gentlemen right here, Keith Duncan, Wade Myers, and Wes Lyons.
Okay.
All fantastic guys, love the Lord, and they are the principals of Waymaker. And no worries, man. Yeah, tell them I sent you. They'd be happy to chat with you. They're pretty accessible guys. I'm sure you can find them on LinkedIn as well. So
okay, great. Thanks very much. Then I'll shut up now.
Yeah, thanks, Ian. Any more questions before we jump out of here? Thanks for being here. I hope this was helpful. Like I said, I'm sure it was, just because I know these were some of the questions I was looking for early on, and I'm happy to be able to provide those. Again, Kingdom REI, if you're looking for in Ian or anybody else, these are projects you're doing, you want to be around a community like this, these are the conversations we're talking about. We have 3 in-person masterminds scheduled for next year: Orlando, San Diego, and Dallas. And then we have 3 in-person workshops planned that are based around story branding. So learning how to tell the story of your company and getting that out to the market, how to really build an automated sales process for either raising money or deals or whatever that might be. And then a different sales and marketing workshop. I have found why are you doing so much sales and marketing? Well, to be honest with you, it's because real estate investors suck at sales and marketing. It's why most of us fail to scale our business, is because we worry and focus so much on the real estate and not enough on the branding, the business side of things. And so doing this for the past year, I've really seen what our community needs. And so that's a big focus for us in 2021. So we'll have 6 events, and then we do monthly virtual events as well. So we're together a lot. And so if you're interested in that, connect with me. You have my email, reach out to me directly. We can schedule a call to see if you qualify, and be a part of that community in 2021. So don't hesitate to reach out to me there. I really enjoyed this, everyone. Blessings to you. And we got several of these webinars coming up. So I'm excited to keep doing these. Let me ask real quick, since there's a couple of folks on here, if anybody would type other topics that you're interested in doing or interested in hearing about. I would love to either speak on them myself or even bring in other experts. We're going to, in the next few weeks, we have scheduled, I'm bringing in my real estate partner. We have created a deal calculator to help us do underwriting for deals in about 10 minutes to let us know if this is a deal that we should really look at or not. Saves us a ton of time. And we actually were able to bring in an intern who could essentially do, we get so many deals. And if you want to be competitive and make offers, you can't do serious underwriting on every deal you get, right? I mean, that would just be crazy. And so we've created a calculator and a system that's so good and that allows us actually just bring an intern who can just kind of punch numbers and then tell us, hey, this is the deal we should follow up on. And so we're going to be talking about that in the coming weeks. Again, we just did one on podcasting. So there's all kind of different topics that we've done and we plan on doing. So if there's anything that you want to hear about, I don't see it in the chat, but email me, reach out to me, and be happy to see if we can line something like that up.
This is Josh.
Hey, Josh.
Hey, Kathy.
Josh, talking to me? I don't think so. Josh answered a phone call. Unmuted. All right, everyone. Well, great. Merry Christmas, and we'll see you next week.
Thanks, Ellis. Have a great day.
All right, David.